Okay. So what's hard about this chapter is just the concept of the fact that sometimes we pay for stuff in advance and then we have to recognize how much of it we actually used. And anyway, it's confusing. So for me, the easiest way is to break it into kind of four categories, or four types of adjusting entries, which is what the book does too. Um, so the first category, and if you have a question, just like ask me. You don't have to, wait for me to finish or whatever.
Sure.
Um, I'm going to share my screen over here. So I just have an Excel spreadsheet up here on my screen right now. And so the first category are what are called prepaid, or deferred expenses. This sounds really, I don't know, intimidating to me, because it sounds like, what are they even talking about with that name, deferred expenses? All it means is sometimes we purchase an asset that will then be like used up in the future. And
Right.
so a good example would be like when we buy insurance for the next year. We can't
Right.
really just say it was an expense the whole year's worth when we bought it. Instead, we have to recognize that we have an asset called prepaid insurance, right? And then we'll be using up some of it at the end of each month or whatever. Um, and so that's the first type. So, for example, if I bought insurance, let me just if I bought insurance, if I paid for a year's worth of insurance, I would debit an account called prepaid insurance. So let's just say it cost me $2,400 to buy insurance for the whole year. And
Okay.
then I would credit my cash 2,400. So that's what it would look like when I paid for a year in advance of my insurance. So,
Okay.
so the balance, this is like a T account here. Okay. So let me just make it look prettier. So the balance of my prepaid insurance account when I did this would have a debit balance of 2,400. What that means is I own insurance for the next year. I $2,400 worth of being insured. So if I get to the end of the month and I want to recognize now that I've used up some of this prepaid insurance, I have to do an adjusting entry. And so the thing I'd have to figure out is, well, how much is 1 month's worth? So if 2,400 is for a whole year, that means $200 a month, right?
200. Uh-huh.
Yeah. So I would do an adjusting entry at the end of the month to do insurance expense and prepaid insurance. What this would do is it would recognize now that I have an expense for $200 worth of insurance, and that my prepaid insurance asset would now have a balance of 2,200.
Okay.
Does that make sense or no?
Yes.
Okay.
Yes, it does. So
So
you're okay. Yeah. So whatever now, like if you're spending cash, now it's gonna go towards credit. And well, on this case, like you paid cash for the insurance and that over here goes on credit, and then you used up 200, so that's gonna go. Um, okay. So is it all the time where it's gonna ma equal to zero, like your debit and your credits are gonna be like matching? Like do they always equal to zero, like at the end?
yeah, so every entry, every journal entry has to be balanced, has to have debits and credits of the same amount.
Okay.
And so all that the deferred expense journal or adjusting entries are is when we have an asset that we're going to then use up over time. So prepaid insurance, we're going to use it up over the next year. And so this adjusting entry that we do at the end of the month is just to recognize, okay, I've now used up $200 worth of prepaid insurance. So the asset goes down or is credited. And then I now have an expense. After we do this for a year, right? If we do the next month, we do the same entry, debit expense and credit insurance, and do that for 12 months straight. Now our prepaid insurance will have a balance of 0, and we'll have recognized $200 each month as insurance expense.
Okay.
So this only comes up when we've paid in advance for something, and now we have to show at the end of each month or at the end of each year how much of it we've actually used up and taken an expense for.
Okay.
So deferred expenses always look the same. You debit, and your adjusting entry is a debit to the expense account and a credit to the whatever the asset account is, whatever your prepaid asset is. Always look the same pattern.
Okay.
So that is the same sort of thing happens with supplies, same type of issue. Like, right, if I buy, if I were to buy $1,000 worth of supplies, I would put that down as $1,000. And then if I paid cash for them, I would credit cash. And then at the end of the month, I'd have to be like, well, how much supplies did I use up? So I'd probably go and count up my supplies and say, oh, I still have $700 worth of supplies left. So I must have used up 300, right?
Mm-hmm.
So I would do supplies expense of 300. And I would do supplies, the asset, of 300. And that would show that I used up $300 worth of supplies during the month.
Okay.
So yeah, just recognize deferred expenses always mean I paid in advance for an asset, usually with cash or accounts receivable. Accounts payable. And then the adjusting entry is always just showing, taking an expense for the amount that I used and then lowering the asset by that same amount.
Okay.
So that's the first type of adjusting entry. So the second type is what's called deferred revenue. So a deferred revenue is where someone pays me in advance for something, but I haven't actually earned the money yet. So let's
Okay.
just say, as an example, like I used to own a storage shed business. So
Uh-huh.
someone comes and says like, hey, I'm going to just pay you for a year's worth of storage instead of month by month. Happens a lot, actually. So if that
Okay.
happened, my cash would go up. Let's say it was $100 a month and they paid for a year. So my cash goes up by $1,200. So I debit cash. And then I have to credit an account called unearned revenue.
Earned revenue. Mm-hmm.
And unearned revenue is weird because even though it has revenue in its name, it's actually a liability account. It means
Right.
what I owe is I owe the use of my storage shed to these people for the next 12 months, right?
Right.
And if I can't give them that, then I need to give them their money back. So I owe them one thing or the other. So the adjusting entry then would be each month to recognize that I've now earned some of that money. So I would debit the unearned revenue account and credit the revenue account. So now at the end of a month, I have earned $100 worth of revenue and I'm decreasing this liability by 100. At the
Oh,
end,
okay.
at the end of 12 months, I'll have an unearned revenue account balance of 0. And I'll show $100 of revenue for each month for the 12 months.
Okay, so you're adjusting entry is when you make the specifics, like, well, you've earned so much and then you have to adjust it as you go as the time moves forward.
Right,
But
right,
the cash in the beginning that they spent, that goes in your general ledger.
right. So I got $1,200, but I haven't earned it all yet. That's why I put a
Okay.
liability. Then as I earn it, I reduce the liability by the amount I earned.
Okay, but that is like how you said an adjustment entry.
Mhm. Yeah, so
Okay.
these ones are the adjusting entries. And you'll
Okay.
notice the adjusting entries always are dated like the end of the financial period. So if you're measuring a month, then they're always dated the last day of the month. Or if you're doing a year,
Right.
it's always December 31st.
Okay.
Because we get to the end of the year and we're like, okay, how much of that did I actually earn this year or this month, whichever I'm measuring? Or how much of these supplies did I actually use during that month? So those are the deferrals. The deferred expense is where I get an asset in advance because I paid for it. And then each month I do an adjustment to show that I'm now actually incurring the expense by, using that insurance for a month.
Correct.
And then
Okay.
and then deferred revenue is kind of the opposite of it. Like if I was the business who got paid in advance, now I'm showing that I earn the money each month.
Okay.
So with the adjustment, you'll notice adjusting entries never have cash in them because the cash always happened back on the original entry. So like with an expense, we paid the cash up front. Now the adjustment shows how we're recording the expense of that cash spread out over the time when we use the insurance or the time when we use the supplies.
Okay.
Likewise with the revenue, the cash happened up front, and now we're showing how we are actually earning that revenue spread out over time.
Okay.
Does that
Mm-hmm.
help with like conceptually with what those two things are?
Right, especially to know, because I was thinking that I was gonna have like a third entry with, cash and what happens, how do I specify? Yeah, that helps a lot knowing that, what goes in the
Okay,
um adjustment that it has no cash. Yeah, because that took place first. Okay.
good. All right. So now so these were our deferrals, deferred expense and deferred revenue. So the
Mm-hmm.
third type of adjusting every entry is called an accrued expense. To accrue something, right, means kind of like to build or add it up over time. Um, so accrued expenses are these costs that add up over time, but we're not usually keeping track of them as we go. So the most common type of accrued expense is what's called like accrued salaries or accrued payroll. Because what happens is most people just pay their people, every other Friday or on the 15th and 30th of the month or whatever. And so normally we just when payday comes, we just pay them and then record that as an expense and we're good. But when the end of the month comes between paydays, this is why people like to pay on the 30th because it makes this nice and clean. But if you pay people, say, like every 2 weeks, sometimes you'll get to the end of the month and you'll owe your employees money for the work they've done, but you're not going to pay them until the next payday. So we have to do this entry to recognize the expense of the work they've already done so that because what happens is if our paydays cross 2 months or two financial periods, that means that our employees have earned part of their money and we've incurred part of the expense in 1 month and then the rest of the expense in the next month that are all on that same paycheck. Does that make
Mm-hmm.
sense?
Mm-hmm.
So at the end of the month, we have to recognize the amount that people have earned. So let's say we pay, $1,000 a day for payroll between all of our employees. And we pay people every other Friday. And so we get to the end of the month and it's a Thursday, meaning we've accrued salaries expenses for 5 days or for 4 days, sorry, Monday, Tuesday, Wednesday, Thursday. So what we do is we say if it's $1,000 for the week,
You're gonna accrued 4 days.
right? So I'll just take 1,000
Uh-huh. Which would be 800.
divided by 500, right? By 5, and then multiply it by 4. Yeah, so 800. So I'll say salaries expense were 400. I'm sorry, we're 800.
Uh,
And my salaries payable will be 800. So there's my adjusting entry. Then on the next payday, right, where I pay my whole $2,000 out to my employees, then I would do so now I would be getting rid of this salaries payable from the previous financial period and claiming as an expense the remaining salaries that we paid during this financial period and paying out the whole thing in cash. So with the accrued, the adjusting entry comes first because we're recognizing, okay, end of the month, how much have my people earned during this month that I haven't yet recorded? In this case, it was 4 days or $800 worth. Then later on, we do our entry to show when we actually pay the cash. But this is our adjusting entry here. Does that make sense, or is it confusing, or both?
No, I kind of get it to where like comes out to 2,000 salaries payable, salaries expense. I'm just kind of like putting it all together, like whoa, that was a lot of numbers at the end, like really fast. So you're considering what you owe and then you're attaching it to a new week's pay? Is that what it is? Like,
Right. So, yes. So if we pay our people every 2 weeks, then, and they've earned 4 days worth of pay at the end of the month, but we're not going to actually pay them until the next payday, which is in the next month. We want to recognize the expense during this month. So there are adjusting entries to recognize they've earned 800 during the current month. And then on the next paycheck, we'll get rid of that salaries payable. And then we'll recognize the salary expense they've earned during the current month. And we'll pay them the full $2,000.
okay,
So what happens is our paydays don't always fall cleanly on the last day of the month.
okay. But so you have to report it, right? So
Right,
the expense, you have to report it on your adjusting. So you would set it there, but you would set it as a liability as the payable
right,
for 800. And then when he receives a check, you give him his salary, which now goes on a debit. And then it's salaries payable. Now it's that you have given it to him, and then but that salaries expense of 1,200, would that be like the other 2 weeks that he worked completely
right.
and he
Yeah.
received
So
full payment? Okay.
yeah. So if there's 10 days worth of pay in this $2,000,
Uh-huh.
so this represents that there were 4 days during, let's just say during September that the person earned, and then
Okay.
6 days, whoops, six
Yes.
days during October.
Right. Okay.
So this paycheck, we're paying him his whole paycheck on October 6th or whatever it is.
Uh-huh. Okay.
And 1,200 of it is money that he earned this month. And the
Okay.
other 800 is money he earned last month.
Okay.
But the only reason we had to go through all this trouble is we needed, at the end of September, we needed to show this expense on our income statement
Oh,
for September.
okay, because it's on a different month.
Right.
Okay. Okay, got it.
Yeah. So it's whenever these transactions cross these financial periods of time, we have to do an adjustment to say, well, I need to recognize the expense I incurred this month.
Okay.
So even though I haven't paid it yet, and I won't be paying it till next month.
Okay.
Does that make sense?
Yes.
So that's an accrued expense.
Okay.
And then, so the last one is an accrued revenue. So with an accrued revenue, and again, this kind of depends on the type of business. A lot of service-based businesses do this, especially like attorneys and accountants, where we just sort of like keep track of our hours during the month, the number of hours we worked for a client, and then we get to the end of the month and we bill them. Okay. So it's pretty common to really not be keeping track of it closely other than writing down the hours. So when we get to the end of the month, we recognize we've earned some money this month, but we haven't been paid for it yet. So let's say I'm doing work for my clients and I see that I've done 10 hours for them this month and I bill out at $200 an hour. So when I get to the end of the month, I'm going to do an adjusting entry to show that they owe me $2,000
Okay, accounts receivable, yeah.
and that I've earned that. So whatever we can just call it revenue or service revenue if I can type.
Surface revenue, okay.
So there's our adjusting entry at the end of the month to recognize we've earned this $2,000 during the month, and it's still owed to us. Then when the client pays us, it will be
And that would go on the adjusting.
so this is the adjusting entry, right? The recognition that we've earned the money this month. So here's our adjusting entry. So these adjusting entries always occur at the end of the month. So the ones I'm highlighting in green are the adjustments. Whoops, not that one. Sorry. Let me make sure. Oh, no, that was right. Those are our adjusting entries.
Oh, okay.
So with the
So with
deferrals,
accurate. Okay,
sorry,
so with the accurate, what do you call them? What's that word spelled?
accrued,
Accurate, they go first.
right,
The adjusting goes first. Okay.
right. And yeah, and that's the pattern you'll see with deferrals. It means you either paid cash or received cash in advance, and now you have to record how much of that expense or you've how much of that expense you've incurred or revenue you've earned
Okay.
later. And then with the accrueds, it's recognizing the expense or the revenue in advance, and then you're going to collect on it later or pay it later. So that's what makes them that's the difference between the deferral and where the expense will be claimed later, and the accrual where the expense is recognized now but we'll pay it later.
Okay.
Does that help with at
Yes.
least with conceptually what we're dealing with here?
Right.
So what makes these especially difficult is that they'll often present them to you in different ways. Like sometimes, for example, they'll say something like, at the end of the month, the company recognizes that they've used up $200 or of this prepaid insurance. So it just gives you the amount. And then you'd be like, okay, so that's easy. I just do prepaid insurance expense. But then in another one, it'll say something like, in January, the company paid $2,400 for a 12-month insurance policy. And then you have to like figure out, okay, 2,400 divided by 12 months is 200. And so they'll present the same problem in a couple different ways. Sometimes where they just give you the amount you need to adjust, and other times where you have to calculate it. And that can really be confusing for if you're like me or most other people.
Yeah, I can understand that.
So you
Yeah.
have to read it really carefully because it's easy to make mistakes.
But they would specify that how much would he have used up within this month, right? Or something like that. They would say that or
Sometimes they do. Yeah, sometimes they'll say, or they'll say something like his expired insurance was $200, which means the amount used up. Other times they
or
won't. They'll just tell you it was 2,400 for the year, and they'll expect you to
okay. So I
divide
saw a
it
problem.
out and figure
Yeah.
out that it's 200.
Okay. So I saw a problem like that to where they bought it in December. You had to credit them from December and then the balance was for the rest of the 2 years.
Right,
And then you had to divide a full year and then whatever was left was for the second year. I
right.
saw a problem like that. Okay. I
Yeah,
get it.
and just recognizing that when we do expenses, we're always debiting them and revenues are always being credited. That helps a lot. I think like that's something you have to get locked down. Like in real life, you always debit expenses unless you're fixing like an error or something, because or when you're closing the entry, but that's way later. So just recognize when we're dealing with an expense, we're debiting it, and we're dealing with a revenue, we're crediting it.
All right. So I
That'll
was
make,
right at the beginning.
yeah, you were. Anyway,
Okay. Thank you so much for
so,
your help.
well, I hope it was helpful, and I hope the video will help some other people.
Thank
All
you.
right. Well, have a great night.
Thank you, brother. Bye-bye.
All right. Bye-bye.